Investing can be scary. You are putting your hard-earned money on the line, but it can also be rewarding. You can grow your wealth and achieve your financial goals. The key is to invest wisely. You need to understand what you are investing in. That means understanding financial statements. Financial statements are like a company's report card. They tell you how the company is doing financially. There are three main financial statements: the income statement, the balance sheet, and the cash flow statement. These statements provide valuable insights into a company's financial performance, its assets and liabilities, and its cash flow dynamics. By learning to read and interpret these statements, you can make more informed investment decisions. The income statement is like a company's profit and loss statement. It tells you how much money the company made, revenue, and how much money it spent, expenses, over a period of time. The income statement is divided into two parts: revenues and expenses. Revenues are the money a company earns from selling its products or services. Expenses are the costs of doing business, such as the cost of goods sold, salaries, and rent. The difference between revenues and expenses is the company's net income or profit. If revenues are higher than expenses, the company has a profit. If expenses are higher than revenues, the company has a loss. The balance sheet is a snapshot of a company's financial health at a specific point in time. It tells you what the company owns, assets, what it owes, liabilities, and what's left over for the owners, equity. Assets are things that a company owns that have value. This includes things like cash, accounts receivable, money that customers owe the company, and property, plant, and equipment, PP&E. Liabilities are what a company owes to others. This can include accounts payable, money the company owes to suppliers, salaries payable, money the company owes to employees, and debt. Equity is the difference between a company's assets and liabilities. The balance sheet follows the basic accounting equation: assets equals liabilities plus equity. This equation must always balance. The cash flow statement tracks the movement of cash both into and out of a company over a period of time. It is a crucial financial document that helps stakeholders understand the liquidity and solvency of a business. By examining the cash flow statement, investors and managers can make informed decisions about the company's financial health and operational efficiency. It provides a clear picture of how a company generates and uses its cash. This insight is essential for assessing whether a company has enough cash to cover its short-term liabilities and invest in future growth opportunities. Without a proper understanding of cash flow, businesses may face liquidity issues that could jeopardize their operations. The cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. Each section provides unique insights into different aspects of the company's cash management. Understanding these sections helps in identifying the sources and uses of cash, which is vital for strategic planning and financial analysis. Operating activities are the day-to-day activities of a business, such as selling products or services and paying expenses. This section reflects the core business operations and indicates how well the company is performing in its primary business activities. Positive cash flow from operating activities is a good sign of a company's operational efficiency. Investing activities include the purchase and sale of long-term assets, such as property, plant, and equipment, PP&E. This section shows how much money the company is investing in its future growth. It also includes cash flows from acquisitions and disposals of subsidiaries and other investments. Understanding investing activities helps in evaluating the company's long-term strategic initiatives. Financing activities involve a company's debt and equity. This section includes transactions related to borrowing and repaying loans, issuing and repurchasing stock, and paying dividends. It provides insights into the company's capital structure and its strategies for financing its operations and growth. This includes issuing stock, taking out loans, and paying dividends. By analyzing the financing activities, stakeholders can understand how the company is raising capital and returning value to its shareholders. It also helps in assessing the company's financial leverage and risk. The cash flow statement is important because it shows how much cash a company is actually generating from its operations. This is crucial for determining the company's ability to sustain its operations, pay off debts, and invest in growth. Unlike net income, which can be influenced by accounting policies and non-cash items, cash flow provides a more accurate picture of a company's financial health. This is a more reliable indicator of a company's financial health than net income, which can be affected by non-cash items such as depreciation. By focusing on cash flow, investors and managers can make better decisions about the company's financial strategies and long-term sustainability. Understanding the cash flow statement is essential for anyone involved in financial planning, investment, or management. Section 5. Connecting the dots. Ratios and metrics. Financial ratios and metrics are powerful tools that investors can use to evaluate a company's financial performance. These tools help in making informed decisions by providing a snapshot of the company's financial health. These ratios provide insights into a company's profitability, liquidity, efficiency, and solvency. By examining these metrics, investors can determine how well a company is performing in various aspects of its operations. For example, the price-to-earnings or PE ratio is a popular valuation metric. It is widely used by investors to gauge whether a stock is overvalued or undervalued compared to its earnings. This ratio compares a company's stock price to its earnings per share, or EPS. A higher PE ratio might indicate that the market expects future growth, while a lower PE ratio could suggest the opposite. A high PE ratio may indicate that investors are optimistic about the company's future growth prospects, believing that the company will continue to grow and generate higher earnings. While a low PE ratio may suggest that the company is undervalued, this could be an opportunity for investors to buy stocks at a lower price, expecting the value to increase in the future. Other important ratios include the debt-to-equity ratio, which is crucial for understanding a company's financial leverage. This ratio helps investors see how much debt a company is using to finance its assets relative to the value of shareholders' equity, which measures a company's financial leverage, and the current ratio, which assesses a company's ability to meet its short-term obligations. This ratio is essential for evaluating a company's liquidity and short-term financial health, which assesses a company's ability to meet its short-term obligations. A higher current ratio indicates that the company is more capable of paying off its short-term liabilities with its short-term assets. By analyzing these ratios, investors can gain a deeper understanding of a company's strengths, weaknesses, and overall financial health. This comprehensive analysis helps in making more informed investment decisions and understanding the potential risks and rewards associated with investing in a particular company. Section 6. Practical applications for stock investors. Understanding financial statements is essential for making informed investment decisions. These documents provide a comprehensive overview of a company's financial health and performance. By carefully examining a company's income statement, balance sheet, and cash flow statement, investors can gain valuable insights into its profitability, financial stability, and liquidity. Investors can assess its financial performance, track revenue growth, and understand cost management strategies. They can identify potential risks and opportunities, such as market trends, competitive advantages, and operational efficiencies, and determine whether its stock is overvalued or undervalued by analyzing key financial ratios and metrics. For example, if you are considering investing in a company, you would want to look for a history of strong and consistent earnings growth, which indicates a stable and potentially profitable business. You would also want to make sure that the company has a healthy balance sheet with manageable debt levels, ensuring it can meet its financial obligations without compromising growth. Additionally, examining the company's debt-to-equity ratio can provide insights into its financial leverage and risk. And you would want to see that the company is generating positive cash flow from its operations, which is crucial for sustaining business activities and funding future growth. By using financial statements to evaluate potential investments, you can make more informed decisions and reduce the risk of investing in underperforming companies. Ultimately, this approach can increase your chances of making profitable investment decisions and achieving your financial goals. Section 7. Spotting red flags and warning signs. While financial statements provide valuable information, it's equally crucial to be aware of potential red flags. These warning signs might indicate financial distress or accounting irregularities, warranting further investigation. One common red flag is a sudden and unexplained surge in revenue or profits. This could be a sign of aggressive accounting practices or even fraud. Another warning sign is a significant increase in a company's debt levels, especially if its cash flow from operations cannot support the debt burden. Investors should also be wary of companies with consistently negative cash flow from operations, as this could indicate underlying business problems. By being vigilant and recognizing these red flags, investors can avoid potential investment pitfalls and protect their capital. Section 8. The power of fundamental analysis. Mastering financial statements is a cornerstone of fundamental analysis, a method of evaluating securities by analyzing a company's underlying business fundamentals. Fundamental analysts believe that a company's intrinsic value is determined by its financial performance, its industry position, and the overall economic environment. By digging deep into financial statements, investors can gain a comprehensive understanding of a company's business model, its competitive landscape, and its growth potential. This information empowers investors to make informed decisions based on a company's fundamental value rather than short-term market fluctuations or speculative trends. Fundamental analysis provides a solid framework for identifying undervalued stocks, assessing investment risks, and building a well-balanced portfolio for long-term financial success. Section 9. Conclusion: Your financial journey. Understanding financial statements is like learning a new language. It opens up a world of possibilities for investors who are willing to put in the time and effort to learn. By mastering the income statement, balance sheet, and cash flow statement, you can gain valuable insights into a company's financial health, its profitability, and its growth prospects. This knowledge empowers you to make more informed investment decisions, identify potential risks and opportunities, and build a solid foundation for achieving your financial goals. Remember, knowledge is power, and when it comes to investing, understanding financial statements is one of the most powerful tools you can have in your arsenal.